Hi, this is Charles Dobbins. I'm the multifamily attorney, and I'm coming to you and the call after the call. Tonight's call was phenomenal. It was great. We celebrated a closing that should be taking place, in about 2.5 hours from now for one of my students. He's buying a 48-unit apartment complex in Kentucky. Bravo, bravo, well done. He nursed it from beginning to end. He's got himself a nice property that's going to be a great launching pad to his 1,000 units. He'd already owned a property before, but this is a little bit bigger scale, so that was a great deal. We have another student who should be closing on a much bigger deal next week. Fingers crossed, we get that one across the finish line as well. But we had a bunch of topics that we talked about tonight. The one that I want to bring to your attention was really cool. I had two of my most successful students on the call, and they both have the exact same investment strategy, but they come about it in different ways. Now that sounds strange, but let me explain. Their strategy is to refinance the investors out of the deal so that they own 100% of it. Right? Who wouldn't want to do that? I mean, these guys own millions and millions of dollars of property, and they did it all by using other people's money, and as soon as they could, they gave those people their money back, and they kept the property. Now, how do they do that strategy entirely differently? One investor uses debt, and the other investor uses equity. Now, for some of you that are on this call, you're like, well, I don't understand the difference between debt and equity. Well, let me explain. Your mortgage is debt. Your second mortgage is debt. Your stock in Apple, that's equity. Your raising of private money in a syndication to have your investors own a membership interest in your LLC, that's equity. So how do these two investors do it differently? Okay, so the debt investor, what he does is he goes to his brother-in-law, his father-in-law. He says, listen, I want to buy this property. I know you got a lot of money sitting in your IRA. Lend me the money. I will pay you back a fixed interest rate on a certain period of time, and I will secure that loan with some form of collateral. Okay? Folks, what I just described to you, you've heard a million times. That's debt. The other investor with the equity comes along and says, hey, have I got a deal for you? I'm going to offer you a percentage interest in this deal. And look at how much money we're going to be making in this deal as long as we run the numbers correctly. This investment's going to skyrocket, and you're going to own a percentage of that company. No, it's not secured by anything. You could lose everything, but look at this return you're going to get. So as you can see, one's riskier than the other. One is secured, the other is unsecured. One gives you more reward for the risk versus the other one. So that is how these two investors do it. Now, how do they cash out, refi these two scenarios? Well, if you're doing it with debt, it's very simple. The terms are already spelled out in the loan instrument, okay, in the note, in the mortgage, whatever it is, it's all spelled out. Both parties know exactly what they're getting, all right? So with that particular debt investor, once the NOI gets up to a certain point, once he's repositioned the property and it's cash flow beautifully, he goes back to the bank, borrows his 80% LTV, turns around and pays off the note, and now he's all by himself. He owns the property free and clear. Now remember, when he was evaluating that deal, he had to make sure that the property could support the two notes, the first note from the bank and the second note from his brother-in-law. So he had to make sure that the property was purchased at such a rate that he could do that. Now the other investor, the equity investor, what he does is in his private placement memorandum, In his operating agreement, he clearly spells out, this is what happens when we reach a certain point. We're going to go back to the bank, we're going to refinance the deal, and all of you Class A members will be paid your principal plus a particular return, and you're out. Okay? Now, what they do, some investors may not want to be out, especially if it's a great investment. They want to stay in. So what these guys have done is they put a kicker in there. It says if you don't get out, if you decide to stay in, your membership interest percentage drops. So you own less of a great property, but you own less if you decide to stay in. And that's an incentive to get out. And here's the real kicker, and this is where, and both these guys can do this, but this is where it really is cool. What the equity investor does is he goes out and tells the investors that if you do this, you can get into my next deal. And as long as they're getting that rate of return, they want to get into this next deal. He has created a perpetual fund for himself. So that's what we did on last night's call. It's all a part of the Multifamily Investing Academy's owner forum. It is a great group. We had a lot of fun on the call last night. I sounded just like this, sick as a dog. But you got to check it out if you're not a member yet. Click anywhere on this page where it gives you more information on how to sign up and how to get involved. Would love to have you on board. It's a lot of fun. I can tell you, depending upon when you're watching this, right now it's an open invitation to the owner forum. In the next couple of months, it's going to be an application-only process. So if you can get in now, get in now. Otherwise, you're going to have to apply and be accepted into the owner forum because it's the best group of multifamily investors on the internet. And it is such a great, lot of fun. We have a good time. We also get deals done, and that's the key. All right. Charles Dobbins, the multifamily investor, multifamilyattorney.com, signing off, and we'll talk to you next week.